Nothing can stop me. I'm all the way up. All the way up.
What's up, traders? Welcome back to RoyalBluFX. In today's video, we're going to talk about the psychology behind the banks. We're initially going to talk about these three things right here that the banks do, so that way you can, once you understand this, you're going to be able to actually get a good sense of what the banks are trying to do in order to leverage your own sort of psychology in the market in order to get good trades in the market. Okay, so without any further ado, let's begin. All right, so here we go. As you can see, the first things first, banks go after liquidity. Okay, we all know what liquidity is. All right, if a lot of you don't know what liquidity is, please refer to my videos right over here. There's going to be a banner that pulls up right over there. Okay, but essentially, liquidity is essentially just a pool of money in the market, a pool of money in the market. Okay, so if prices are going up like this, right, you can see there's a lot of support and resistance. All right, a lot of retail traders are trading this. Right, there's the support, right, whatever you want to call it here. There's that support, right, and there's that resistance. Okay, that's what liquidity essentially is in the market. Okay, and so what happens is prices are actually being created like this, and then there's a lot of buys and sells that are happening like this, right? There's a lot of sell stop orders and buy stop orders right above and below these areas like this. Okay, and so what the banks are doing is they're saying, okay, well, we want to target this liquidity, whether it's the buy side or the sell side. Okay, so if prices are continue higher, the market's going to drop like this, right? Take a sweep of all this liquidity, and then then the market's going to push to the upside, right? Taking out the buy side liquidity, right? And then wait for the market to retrace back like this. Wait for for the market to come back to an area of demand, and then push the market to the upside like this. Okay, so essentially, there's many scenarios the way what liquidity looks like in the market. This is just one of them, obviously. Other ones that you can see are something like this. Okay, we all know the double bottoms, right? The double bottoms. All right, there's liquidity right at the lows like this. So there's liquidity sitting at the bottom, which means banks are going to go after this eventually, and then look to move prices, to continue prices probably in the same direction like this, something like this. Okay, you can see that there's a sweep of liquidity and prices push to the upside like this. All right, and of course you can talk about the double tops as well, whatever, something like this, right, where prices do this, come over, take that liquidity, and then push prices to the downside like this. You can see that there was triple tops like this, double tops like this, right? There's a bunch of liquidity resting at the highs. Prices go up, take that liquidity, and push prices to the downside. Okay, so that's just liquidity. Okay, so another thing that banks do in the market is they create liquidity. All right, so the famous saying in the market, and from what I've learned, was if you can't see liquidity, you are the liquidity. Okay, so let me just show you this example here. When prices are pushing up again, right, you can see there's order flow pushing like this. Okay, and prices go all the way to the highs like this, and then come all the way down like this. You can see that liquidity was building right along the way. This doesn't mean that you can't trade the liquidity, because you can, as long as you know that there's liquidity building. All right, liquidity is mitigation, and mitigation is liquidity. Okay, so when prices are pushing up like this, going up, coming down, respecting the slow, breaking above a new high, coming right back down, something like this, right, respecting the slow, continuing to do the same movement. Prices essentially creating liquidity like this. All right, so and this is only for the banks to use this money that they just this liquidity that they just build. So you're being manipulated while you're actually trading this liquidity, right? You're trading this order flow. All right, and then prices just come down like this against you, and then all of a sudden take out all this liquidity. Prices then push up, right, and come right back down, and then continue to the upside like this. Why? Because again, if we're just following order flow and we see that the banks are after liquidity, then we know that prices should continue to the upside like this. To the upside like this, or essentially maybe potentially who knows, market can do whatever, right? Create more liquidity like this and push the markets down, manipulating you a little bit more, right? And then push prices to the highs like this, right? The banks can do whatever, right? But we just need to understand that one of their scenarios is to create liquidity, all right? If you can't see the liquidity, then you are the liquidity, okay? The last thing right here, the third thing is the last one, okay? So the banks also need to mitigate. Okay, their intention in the market is to also mitigate an order block or supply or demand level, only because they're trying to move prices at a different direction or continue the market in the same direction. So let's go this next example here. Okay, prices are going up, right, like this, and you can see prices are breaking, mitigating, breaking, mitigating, breaking, mitigating, breaking, mitigating. Now the only reason why they're doing this is because they're saying to themselves, okay, well, the order, the sell, we're not selling now, right? We're looking to buy. Banks are thinking to themselves psychologically that, hey, we're still pushing price up, and we know the intention why they're pushing price up. Well, the intention they're pushing price up is so that they can create the liquidity, the sell side liquidity like this, okay? So that way, essentially, dummies, whoever is selling, whoever buying this, right? You'll be taken out easily like this, and then you'll be able to you'll lose all your you'll lose your order your buys, obviously, and then the markets continue bullish like this. Okay, so essentially, anytime in order for the markets to do anything, in order for the banks to do anything, they need to always mitigate. Okay, so if we understand the psychology behind the mitigating, okay, we can understand why they're mitigating and what they're going after from the mitigation point, okay? Let's give you another scenario. When prices are going up like this, okay, you can see that there's beautiful order flow pushing up, right? And then you can see prices are mitigating like this. All right, now you can see when prices are giving out, look what's happening. Prices retrace all the way back below like this. And then now you're thinking, okay, well, is the direction up or down, right? You can see the overall direction is pushing upwards, right? While prices are breaking and mitigating like this, you can see that there's a break right here, obviously, right? All right, there. And then you can see prices actually mitigated this low right there, okay? So our initial thought would be, okay, well, once price mitigate, what are we looking for? Well, we're looking for another break of structure, right, to continue that order flow, right, the flow of orders. And we're looking for price to come back to an area of demand and then continue prices bullish, right? Here, that's not what happened here, right? Prices respected an area of supply here and then pushed prices to the downside. Now, starting to make you as a trader, as the retail trader, a little bit confused. Now, if you understand the bank's intention, though, you'll understand that we're still in a bullish market, right? Only because we understand the bank's intention is to create liquidity, and also it's to go after liquidity, okay? So you can see here, banks created liquidity with the form of mitigating, right? Banks are breaking a new high, right? Telling us the price should continue higher, right? There's buyers that are here. We're looking to buy here, okay? There's buyers that bought there, right? The price all of a sudden reversed. Now we see that clear liquidity. We see that banks just clearly created liquidity. Gives us a good intention to say, okay, well, we know whenever we have to understand, well, we know if banks are taking out liquidity, what is the bank's intention? Is to take your money and push the markets in the opposite direction or in the intended direction, okay? And that's the real trick over here, the real psychology, right? So now here you can see that we have an area of demand, all right? Once prices get to this low here, our intention is as a retail trader is to wait for confirmation. Now we wait for that chalk confirmation, right? We wait for that reversal in the market like this, and now we understand that once we take that liquidity, the markets should typically go in the intended direction because the overall direction is up. Okay, first things first, the markets go after liquidity. Boom, they just took liquidity, right? They create liquidity, which was created. That's number two. Now they need to mitigate, which they just mitigated their last position here, and now their intention is to move prices to the upside like this. Okay, and that's what we're looking for in the market, is This is the whole exact scenario that we're looking for in the market. Okay, you would have been able to look for buys here, right, and look to target the current high here, right? Maybe also looking at this high here, that there is liquidity at the very highs right here, and now you can wait, and then markets will be able to take this liquidity from the highs here and then do whatever, right? So those are the three things that the markets do, right? Now, if you want to understand what the mitigation is, right, go and refer to my other video up here. You'll see another banner going right up over here, sliding over there. Okay, just go ahead and click that banner and you'll see what mitigation is in the market. But in a nutshell, mitigation is really just an area where the markets are looking to, or where the banks are looking to close their last previous order before they continue the prices either in the intended direction or change the direction. So in this scenario here, as you can see here, prices are mitigating, right? Let me see here, right, excuse me, right there. Okay, when prices came down, right, here's that last down candle right in here that obviously we can't see, but this is the last down candle in the market, okay, and prices just shot up. So now we need to understand that in order for banks to continue, in order to take more money, okay, they have to close, they have to go after this liquidity, okay, the sell side liquidity, and close their last order here, okay, because right now they're negative in this down candle, okay. Not to say that the banks don't have enough money in the market, because they have millions and trillions of dollars to do whatever they want, right? They can put buys and sells buys and sells wherever they want, wherever they please in the market, right? They just have so many buys and sells, selling orders everywhere in the market. So this doesn't really matter to them, but it really depends on what their intention is in the market on the higher time frames perspective, which we're going to talk about in a live chart example right after this. But so in this scenario here, there's that last down candle that we see right here, okay? They're probably tired of holding this position open, this last down candle. They're taking this liquidity and saying, that's it. It's hasta mañana from this down candle here to start pushing prices to the upside, okay? Because now what they're going to do is close this order, take out all this money, create a new high, breaking a new high, taking the highs liquidity, right, this buy side liquidity here, right, while in this area here they're looking for this internal internal structures liquidity. They're creating more internal structural liquidity in here now, right? Now you have a whole new set of sort of structure to work with, and sort of new highs and lows to work with based off of how the banks are treating this next high, right? So there's a break of structure here. Now, if you can see, prices are doing this now, right? And you're wondering, well, okay, where's the liquidity, right? Well, you know, the thing about this is to really wait for prices to settle, right? We're looking to buy the market at an expensive price, not at a cheap price, right? As you can see here, here's the equilibrium, the 50% equilibrium line here. Anything below this line is our discount. Anything above here is our premium. So in a sense, if you're buying anything in the premium, this is considered to be cheap money. Expensive money, right? You don't want to buy the market at a very expensive price. You don't want to buy the market at a very expensive price here. You want to buy it at the cheapest possible, right? Which is right here at the very low. Anything below the 50% equilibrium line is the cheapest price. So therefore, we would wait for price to settle. Once price settles, right, you can see here there's liquidity being creating right here, right? That would be liquidity in the market for us. So therefore, we would wait for prices to come below here to take out that liquidity, and eventually wait for prices to mitigate this last down move here, and then wait for prices to push, and then look for prices to push to the upside like this. Now you can see the beautiful order flow that is happening on a higher time frame. You can see that this is a low here, this is the extreme low, this is the extreme high, extreme low, extreme high, right? All your intention is just to wait for that liquidity to create, okay? Because that's the bank's intention, is to create more liquidity, to create more orders in the market, you know, to go and trick those retail traders to then take you out and then say, see you later, sucker, I'm going to take that money and then come and mitigate something, close the last order that they've had, right? And then push prices to the upside, right? So that's all they're doing in the market, okay? So let's go in the live chart example right now. I want to go show you a little bit what it looks like over here. Let me just get rid of all this right over here, so you guys can see it all clearly in the market. All right, let's go over here. All right, so we're on the daily. Let's just drop on the 4 hour here. Okay, here we go, 4 hour, like right there. All right. And I'm on the US 100. It doesn't really matter what we're really looking for, right? As long as we just understand that you know, a market's a market. It moves. Every market moves the same, right? As long as you understand the structure. Okay, so what do we see here? Okay, we see that on the 4 hour, the trend is down, right? Everything is down. Everything is bearish. So our intention is to look for sells, right? So in here, you can see price respected this high here. It mitigated this supply zone. If I can see this, here we go. Excuse me, let me just move myself over here for a second. All right, supply, there we go. All right, so once price mitigated the supply here on our higher time frame, we are going to be trading the internal structure. We want to know the intention of the market from a higher time frame perspective. You can see here that we had an area of demand. This is the last low, right? So what we're looking for in here is essentially, if I can move this, okay, there we go. All right, we're looking for prices to respect this now, right? Or at least drop and break. Okay, so once we see our supply and demand into frame here, you can see this is at the highest point at that time. This is at the lowest point at this time. Okay, so once we see this, we're going to focus on the internal structure. Let's look at this here. Okay, prices just mitigated this low here. Okay, remember what I said, prices go after liquidity. Okay, they create liquidity, which you can see right here actually, and then they mitigate, take out liquidity right there. Okay, right there, they take out liquidity and they go and mitigate. As you can see, there's a mitigation that happened here. Supply right there. Okay, they take out liquidity here, they go and mitigate, and then now they begin to drop. Okay, going after more liquidity. As you can see here, there's liquidity right there. Okay, right there, and then prices, what do they do here? They mitigate, right? Now our intention is to look for the next move, right? Since we know the whole thing is bearish, we're not going to be looking for buys, obviously, although you can from this move here, but we have to be very careful. If we drop down on the 30-minute, let's go on the 50-minute. Okay, let's look over here. Prices just mitigated the last demand level, right? They just mitigated. They closed their order. We know the overall direction is down. It's bearish, so we're obviously not going to be stupid to look for buys. Although we can look for buys here, but not for long term. When you're looking for short term. But in this case, you can see there's a huge gap in this market, which is where a market may potentially go up towards. So let's look over here. In order to look for buys, what do we need to do? Okay, we need to see liquidity in the market. If we cannot see liquidity, there's no intention for us to look for buys at this point. Okay, we can see that prices did break this area of supply, so we know the overall direction is bullish on the lower time frame here. So we're going to look for potential entries. Let's look for liquidity. Okay, so there is liquidity here in form of trend. Okay, the trend line right here, right there. Okay, you can potentially look for buys here, right there, right? Okay, and only because let me zoom out here. If you look to the upside, when prices broke above here, notice what happened. There's liquidity sitting and resting right above here. Okay, right there. And if you look right above, you can see. Let me zoom out here for a second and see where that last area was from here. Right over there. Okay. All right, I don't see it, but it's reacting off to this area right here, to the supply. Okay, the highest right here. There must be a hidden order block here that we can't see on the lower time frame. And then prices reacted to the supply area and pushed prices down, right? Now again, when our intention is to look for the liquidity first, right? We're looking at structure first, right? And then we're looking for prices to start creating liquidity, okay? And then we can see that liquidity was created, price broke below, okay? Came back up, took out that liquidity, and mitigated this high now, okay? And this is the psychology behind the banks. They want you to, you can see that there's early sellers in the market here. Prices sold, then now prices went right back up, taking out these guys here, the ones who actually sold way too early in the market, and they were just taken out, right? So once prices did this, right, notice what happened. Okay, notice what happened here. You can see how the intention was for us to look for buys here. Let me just correct this here. Right there. Okay, we have our demand there. Okay, so we could have been comfortable to be able to take this. Oops, excuse me. Okay, we've been comfortable to take this buy only because we understood and we saw liquidity in the market. Okay, liquidation, mitigation, and prices tend to move to the upside like this, right? Just like this, right? So we would have hit our first TP, right? Then we'd have looked to target this high here now to look to target the second TP. This may actually continue going down from here because I see something all the way to the left here. Let's look over here, okay? Now, in order for prices to continue lower, prices must take more internal liquidity. We can see there's liquidity right here resting above, okay, right there. So what are prices doing? They're creating more liquidity here, right? When prices drop, they create internal liquidity. We know that price now has to mitigate the last high, right? That last high right there in that supply area. All right, so we're going to look for prices to mitigate that supply area, and then we look for prices to continue lower, okay? Just like that, right? So there we go. So we would have had a TP on this one. Probably not going to target this high, but we'll target this area and finish right here. Okay, so there's just that scenario, all right, to understanding how banks actually just go to take out liquidity, mitigate, and then create more liquidity for the next move, right? So in order to understand how to be ahead of the markets, we need to understand the liquidity and mitigation process, okay? That's all there is to it, guys, in this video, okay? So I hope you guys understand how liquidity and mitigation works in the market, because they're very crucial to understanding how psychologically the banks work, right? What they're going after. It's very simple, right? So guys, I hope you enjoyed this video. Please throw a like on this, smash that like button, and subscribe to this channel, because I'm always throwing free content. So, you know, I'm always here for you guys. All right, guys, I'll see you in the next video.
Think can stop me, I'm all the way up.